Right now, the crypto market is sitting in something called extreme fear, and it's been stuck there for 30 days straight. Bitcoin ETFs just saw over $6 billion walk out the door. A wallet linked to one of crypto's biggest collapses just moved over $700 million, and nobody knows why. And yet, some of the biggest players in this space just quietly bought more. So who's right? The people running for the exits, or the people buying in silence? By the end of this video, you'll understand exactly what's happening, why it's happening, and what it actually means for you as a Nigerian investor, and not what some Telegram group is telling you. Let's break down the moving parts, because there are three things colliding at once. First, institutional money is pulling back. Bitcoin ETFs have seen billions in net outflows recently, with negative days outweighing positive ones for nearly a month straight. When the big funds pull back, sentiment follows, because retail investors watch institutional money as a signal. Secondly, an old ghost resurfaced, a cold wallet connected to MT. Gox, the infamous exchange that collapsed over a decade ago, moved a massive amount of Bitcoin for the first time in months. Nobody knows for certain if those coins are heading to market, but the mere possibility was enough to trigger a wave of liquidations, because traders aren't waiting around to find out, they're protecting themselves first. Thirdly, and this is the part most people miss, while ETFs were bleeding outflows, altcoins like Solana and several mid-cap tokens actually posted solid gains in the same window. That's not normal everyone's running behavior. That's a market where different players are making very different baits at the same time. Here's something that surprises most people. Extreme fear readings have historically clustered right before some of crypto's strongest recovery periods, not its worst crashes. Fear is a sentiment indicator, not a price prediction. It tells you how people feel, not where the price is going next. That doesn't mean buy because everyone's scared is a strategy that's just replacing one form of emotional investing with another. But it does mean panic selling purely because a fear gauge is red is just as irrational as buying purely because a gauge is green. The smartest investors treat sentiment data as one input, not a signal to act on alone, while retail sentiment sits in extreme fear. Here's what's happening behind the scenes. Corporate Bitcoin holders have continued adding to their positions, even during the downturn, treating the dip as accumulation opportunity rather than a reason to exit. Major Ethereum treasury firms have kept buying too, with some explicitly stating they still believe a recovery, what one called a crypto spring, is coming. This is the same pattern that plays out in every market cycle. Retail investors without deep pockets or long-time horizons tend to feel the fear hardest and react fastest. Institutional and corporate players with longer horizons and more capital cushion tend to use fear as their buying window. That's not a guarantee they're right, but it tells you who's positioned to wait this out and who isn't. If you're investing from Nigeria, market downturns hit differently. You're not just dealing with crypto volatility, you're dealing with it on top of Naira volatility, limited formal investment access, and in many cases, money that represents a much bigger share of your total savings than it would for an investor elsewhere. That changes the math. A 20% drawdown that a wealthy institutional investor shrugs off could represent months of saved income for someone here. This is exactly why position sizing matters more for you, not less. The buy the dip advice you see in international crypto content often assumes a financial cushion that doesn't reflect the reality most Nigerian investors are working with. 3 practical takeaways from everything we just covered. 1. Don't make decisions based on a single sentiment number. Extreme fear isn't a buy signal or a sell signal on its own. It's context. 2. If you're going to buy during a downturn, do it the way the disciplined players do. Small, regular amounts over time, not a lump sum based on a gut feeling that this is the bottom. Nobody consistently calls the bottom, not even the professionals. 3. Protect your foundation first. Your emergency fund and course savings should never be exposed to this kind of volatility. Whatever you're doing in crypto should sit on top of a stable financial base, not replace one. Markets cycle through fear and greed constantly. That's not new, that's not unique to crypto, and it's not going to stop happening. What separates investors who build wealth over time from those who get wiped out isn't predicting every cycle correctly. It's having a system that doesn't depend on getting every cycle right. The headlines will keep coming. Wallets will keep moving. ETF flows will keep swinging. Your job isn't to react to every single one of them, it's to have a strategy solid enough that none of them individually can derail you. If today's breakdown helped you make sense of the noise instead of reacting to it, subscribe. I cover exactly this kind of market context every week, cutting through the panic and the hype to focus on what actually matters for African investors. Drop a comment. Are you buying?